Welcome to Spidell's California Minute. I'm your host, Catherine Zidane, and this week we're talking about making California adjustments to tax basis capital accounts. We cover this issue and other California tax topics such as conformity, legislative changes, and the pass-through entity elective tax in our critical California tax issues on-demand webinar. You can register for this and other webinars at caltax.com under the Webinars tab. For 2022 Forms 565 and 568, tax professionals are required to provide partners and members capital accounts using California tax basis. This was originally required for 2021 returns, but in Notice 2022-01, the FTB granted a one-year reprieve and allowed entities to provide their partners and members capital accounts using their federal tax basis for the 2021 taxable year. The instructions to the Schedule K-1 for Forms 565 and 568 direct the taxpayer to look to the information provided on the partner's tax basis capital account in the instructions for the federal Form 1065 Schedule K-1. We believe this means taxpayers will make California adjustments to the tax basis capital account numbers reported on the Form 1065 Schedule K-1, but we're confirming this with the FTB and we'll keep you posted. We know the thought of recreating a partner's California tax basis seems daunting. Assuming California follows the federal methods for computing tax basis capital account reporting as the starting point for determining the California tax basis capital account, there are some things to keep in mind. Under the federal rules, which we believe are followed by California, small partnerships are exempt from the requirement. To qualify for the exemption, the partnership has to have less than $250,000 in gross revenue for the tax year, have less than $1 million in total assets at the end of the year, timely file K-1s, including extensions with the IRS or FTB, and furnish copies to the partners, and not be required to file a Schedule M3, net income or loss reconciliation for certain partnerships. Taxpayers can use the federal tax basis figure reported on their federal return as the starting point. This means California should recognize the safe harbors the IRS allowed partnerships to use to recreate tax basis on the federal returns, for example, the modified outside basis method and the modified previously taxed capital method. If the only differences between the federal and California tax basis involve depreciation amounts, like Section 179 deductions, bonus depreciation, depreciable life differences, etc., taxpayers can easily convert federal tax basis capital accounts to California tax basis capital accounts. This is done by using the federal and California accumulated depreciation balances as of January 1st, 2022, and running these figures through the increase or decrease on Schedule M2. There are several other differences that could also impact California tax basis that need to be accounted for, like partnerships or LLCs operating inside and outside of California, or income exempt under California law but not under federal law. For example, California COVID-19 small business relief grants, just to name a couple. The only way to truly and accurately get the basis right is to go back and recalculate basis for each partner starting from the first tax return. That was the point of the IRS's safe harbor methods. They recognized that for older entities, this could be an impossible task. We hope that the FTB will adopt a similar approach for 2022. We'll report on any updates to this issue in Spidell's California Tax Letter, a monthly publication written by California Tax Pros for California Tax Pros. You can see what's included with a subscription and download a sample issue at caltax.com under the Publications tab. That's all for this week. Join us next time for another episode of Spidell's California Minute.